Hello and welcome to BTVI. You are watching the Mutual Fund Guide. I am Muralidhar Swaminathan. Joining me on the show are Hemant, Rustagi and Sachin Jain, Fund Analyst at ICICI Securities. Gentlemen, welcome to the show. Thanks for joining us. Today we focus on large caps. Are all large cap funds good to invest? To answer this question, we put all the large cap funds through a simple stress test. Those who lost less than the Nifty in the current market are categorized as resilient ones. From its peak of around 12,100 on July 3rd, 2019, the Nifty has lost almost 8.8%. In a weak market, the strongest fund of the lot, I'll bring it up on the charts, you can see, are the ones which have lost less than JM Large Cap Fund, 3.7%, Axis Blue Chip Fund 3.8%, BNP Paribas 4.83%, HSBC Large Cap Equity Fund 5.68%, and LIC MF's large cap fund is about 5.78. Now these are the top 5 funds which have managed to lose much less than what the Nifty has lost, which we call as funds which are resilient funds. And we will bring up, and later in the show we will also show you more funds. Well, there the list of another set of funds. IDBI India Top 100 Equity 6.19, PGIM India Large Cap Fund, Invesco India Large Cap, Canara Robeco Blue Chip Equity Fund, Mahindra Pragati Blue Chip Yojana, all these are less than 8%, beating the Nifty's returns. This does not mean that you have made money, but you have lost less money than what you otherwise would have lost money, maybe because of the portfolio selection. Hemant, what's your commentary on this?
Yeah, absolutely. I think first I feel that it's too short a period for readers to analyze how good a fund is. And the second is, if you look at the large cap universe, is 100 funds, 100 stocks in terms of market cap, the top 100. Within that, the difference would be, how many funds, how many stocks have been taken. There are some funds which are very diversified, some have taken a focus strategy. Then it depends on which stock is there, which are the top 10, 15 stocks, and the sector exposure.
Correct.
Based on that, and really what we have seen in the market, that very few stocks took the market up. Okay, so wherever those stocks were there and they have corrected, they have fallen more than Nifty. Others which didn't do very well earlier, because those stocks were now there, have fallen less. So, like I said, it doesn't really indicate that these funds are better than the funds which have fallen more in this. There are different reasons for that.
Right. So the funds which have fallen more could be having loads of stocks which perhaps have fallen much more. Sachin, how would you analyze large cap funds in this kind of a market?
We always recommend or always analyze funds based on market cycles and the longevity of the performance.
Right.
The kind of fund manager who is managing, and the experience that the fund manager has been. So we don't recommend purely a 1-year return or a 2-year returns. We look at the market cycle return. So this is just a recent cycle which has panned out, say, since the start of 2018.
Right.
So that's 1.5 year kind of a market cycle, which is in a kind of a down cycle. So you have to look at the prior cycle, when the markets were doing well in 2016 to 18, when the market was not doing well in 2015. Which are those funds? Were these similar funds which were not doing well, which are not doing well right now? How the funds were doing in 2009, 2010 or 2011 when the markets were doing well.
Right.
So are these same funds which were not doing well or which are doing well, which are the same fund to different market cycles? So need to understand these funds. Which we should not recommend a fund basis a pure 1.5 year cycle.
No, this is a very simple stress test we wanted to conduct. Of course, investing in mutual funds, you need to look at a longer term standing of a fund and how they have performed over 5 years. That's a very important note of caution that our guests are giving you. My next question is, in fact, on that note, this morning, Sarup Mohanty had tweeted, he was asking, look, what are the lessons we have drawn from the previous, downturn, especially between 2008 going all the way up to 2012. So I retweeted, I said simply SIP in large cap funds. Is it a good time to start SIPs in large cap funds? What would you advise?
Well, Murli, I think when you are investing through SIP, the objective is very clear.
Right.
That you do not want to commit large sums at one particular market. You want to benefit from the volatility that exists in the marketplace at all times. maybe how much volatility that keeps varying from time to time. So you know that equity by nature is volatile, and you don't want to commit too much money at one certain level. That's the reason why, or you may not actually have the money to invest as a lump sum. So there are different reasons why you start investing through SIP. Whether it's a right time or wrong time, honestly, if today I want to start my investment process and my time horizon, which we always recommend that you should follow a goal-based investment process.
Absolutely.
If I do that today, my belief always is that if you're looking at equity, you do it like for different time horizons, different goals. So long-term money has to go into equity.
Right.
It has to go into well-diversified fund. I would say that, if you're starting for the first time, avoid all kind of fund. Look at large cap related multi-cap funds or large cap fund.
Correct.
My view is that 60% of your portfolio at that stage, at least 60% has to be in large cap fund. Yeah. That has to be the core of your portfolio, because you want to understand equity as an asset class.
Correct.
And how do you understand? These are all large companies, established companies. They are less volatile as compared to small and mid cap. So once you become comfortable with equity as an asset class, then you can start increasing your allocation to maybe a different segment. But I think large cap funds clearly have to be the core of your investment.
Absolutely. Especially I think for new investors, large cap funds matter a lot because they won't get the kind of shocks that one sees in the market, isn't it?
I'm a slightly different view. Okay. Definitely a large cap definitely makes sense. But a multi-cap kind of a strategy always gives leeway
for a new investor.
Yes, even for a new investor. Right. It gives a leeway to the fund managers, to invest where the market valuations are.
Right.
Where which stocks are, finding it cheap. So you can find value across large caps, mid caps, small caps.
Correct.
So why you want to restrict your fund managers in the just top 100 stocks?
Right.
They just give him the freedom to invest wherever he wants to. Correct. And the focus should be more on the selection of the fund managers,
right,
and not on the fund itself.
Okay.
So you do a lot of homework in terms of which fund manager is good. Understand the cycle, last 20 years, 15 years, 10 years, 5 years, and just focus on analyzing the fund manager, and just give him the money and all the freedom in the world, to invest and where you want to invest.
Right.
So when you have selected good fund managers, why to take a head out and want to restrict him on just 100 stock or 150 stock? Okay. Just give him the leeway and just let him do the job and just hope that he will deliver for you.
Absolutely. In fact, that's a very important line. It's not just about knowing your funds, know your fund manager as well. If you know the fund manager, how your fund manager is delivered over a certain period of time matters, because their stock selection strategy varies from one fund manager to the other. On that note, maybe I think I have to take the first query, and this query is very interesting. It is Ravi from Chennai. He has mailed us this question. He is 35 years and he has been investing in the following funds for 3 years. 19,000 rupees in Franklin India Equity Fund, Mire Asset Emerging Blue Chip, 5,000 rupees in DSP Small Cap, 12,000 rupees in ICICI Blue Chip Focused, 8,000 rupees in SBI Blue Chip, 5,000 rupees in HDFC Balanced Fund. That's a lot. He wants to accumulate 1 crore rupees for his kids' education and 3 crore rupees for his retirement fund. All this in the next 15 years. He also wants to increase monthly contribution by 10% every year. I think his objectives, goals are very clear, but it looks like there are too many funds.
No, actually, if you really see, one, his time horizon is 15 years even now.
Yeah.
Second is he's investing around 68,000 rupees.
Correct.
So for 68,000, if you have 5-6 funds, I don't think there are too many in there.
Not too many. Okay.
So if I analyze his portfolio, see what he needs to do is, he's saying that let's talk about his targets. The target is 1 crore for child education. Right. And 3 crore for his own retirement. So if I assume annual return for say around 12%, he needs to invest around 20,000 for the child education and 60,000 for his own retirement. So in all, he needs to invest around 80,000. So right now he's investing 68,000. He wants to increase it by 10%. He already said that. So if you add another 7,000 to that, you're almost there. And I'm sure as he goes along, he will increase the investment amount. So I'm not worried about really whether he's investing the right kind of money or not.
Right.
If I analyze his portfolio, around 60% is going into large cap in different form, which is what exactly I said earlier. It could be either multi-cap fund or it could be large cap fund, but I think the core has to be the large cap. 60% is going into that.
Right.
Another thing is that he has one HSBC balance fund there. I feel that 5,000 and 60,000, which means there is hardly anything in debt. Right. So it doesn't make sense. He should either go into HDFC equity fund. I think that will be better. The additional money that he wants to invest, 7,000 rupees, he has 2 good quality funds, ICICI Blue Chip. He can increase in that. And another one is, Mirai Emerging Blue Chip Fund. He can increase amount in these 2 funds. Right. And if he continues this process for the next 15 years, which is committed to, I mean, I don't see any reason why he should not be able to achieve his targets.
Absolutely. I think, Ravi, you are on track and well planned and great selection. As Hemant points out, you will be able to achieve your target objective of 1 crore and 3 crore, which is very reasonable from the kind of lifestyle and standards that you want to give good education, have a good retirement. Next query, Tarvinder Singh from Delhi. He is invested in Franklin India Income Opportunity Fund and Motilal Oswal Long-Term Equity Fund. He wants to know the outlook of these funds as they have been underperforming in recent markets.
Well, I think let's look at Motilal Long-Term Equity Fund. It's an ELSS fund. We know how the markets have behaved in the last 1 or 2 years. So clearly any fund which is investing in equity, you wouldn't be happy with the performance. But I can tell you, if I look at the category average or in terms of quality of the fund, it's a good fund. So my recommendation is that he should continue investing in that. The second one is the Franklin Income Opportunity Fund. Again, it depends on how much his time horizon is still left from here.
Right.
It's a good fund in his category. So if he's still looking at maybe 1 or 2 years, he can continue in that fund. Clearly it will depend on what is the time horizon from here. If he has a longer term horizon, maybe then he can start looking at some, hybrid fund or some equity fund which can give him higher return from here.
Right, the goals are going to be important. Sachin, let me come to you. If somebody is saying, look, 5 years, 10 years, 15 years, 20 years, the goals keep changing. 5 years your requirement is different. 10th year it's different, 15th year is different. So do people come to you and say that, look, I want to do this kind of goal-based planning? And if that is the case, obviously I have to select somebody in the age group of, let's say, 28, 30, 35. That's when they start planning long-term, right? So how do you advise them? What is your suggestion?
Yeah, so definitely, so you start with your target amount, among the goal-based investing. Then, obviously, you spread across various segments of the markets, so be it large cap fund, mid cap funds. Also, one thing we do is, we always diversify among the investment style of the fund managers.
Right.
So generally people advise you just invest in one large cap, one mid cap, one small cap. But what we try to focus is on investing in different investment style. So some fund managers have a value-oriented investment style.
Right.
Some fund managers have a growth-oriented style.
Right.
Within the value investment style as well, there could be few other fund managers which are following a different kind of strategies.
Right.
So we have SGFC kind of fund houses which follow a different value style.
Exactly.
We have an IPRU MF which follow the different kind of value investment style. So we have a growth investment style like Motilal of the world, SBI mutual fund of the world. So you have to diversify between various investment style. And people need to understand that any particular investment style cannot work across market cycles.
Correct.
So what has worked in the last 3 years, maybe there's a growth investment style. So people need to understand that this style of investing may not work in the next, say, 2 years, 3 years. So people need to vary about it. So that comes to a point that don't invest in a best performing fund.
Okay.
So because if the best performing fund has already delivered, you are already in the up cycle of that. Maybe at the peak of that cycle. So you need to vary about it. So you just don't look at one cycle, one fund manager, because that cycle and the different fund managers have different style and they just stick to it. So it's always better to have that view that which fund manager has a different style and where in the market cycle I am at. So we are already at the market peak. Market is slightly on the expensive zone, slightly on the weak zone. So you need to analyze those. And then select the fund managers. So maybe diversifying across style. And obviously then again my earlier point of fund manager selection comes very handy.
Because in fact, Axis Mutual Fund manager was here last week. He has a different style. He is just focusing on 3 sectors. Right. He doesn't get into every sector like other fund managers do. He says, I look at banking and financial services, FMCG and consumption. And to a limited extent, he is looking at industrials, which are not vulnerable to the cyclical problems. So that's a very, very focused kind of a style. Right. But then there what happens often, the opportunity of, let's say, spotting something in housing finance, for example, everybody is saying don't touch it. Right. That gets lost. Right. Now, if that opportunity is missed, now for the retail investor, it's very difficult to understand and know this because they'll say that, okay, I'm doing 10,000 SIP month after month after month. So if somebody comes to you, Hemant, do you go into these details and explain to them?
Yeah, I think it's very, very important. Let's look at, let's say, any multi-cap fund. If you see all the top performing multi-cap funds, they've actually invested heavily into large cap stocks. And we have seen the large caps done well, so obviously those funds have done well. Any other funds which are very true to their label and who have also invested significant amount in mid and small have underperformed. So basically you have to take investors through that cycle, make them understand that just because they've not done well in the last 1 year or so, it doesn't make them a bad fund.
Right.
Because the risk over there is the top performing funds, if they fail to realign their allocation to different segments,
Correct.
they will start underperforming.
Exactly.
As you mentioned about you're looking at 2 or 3 sectors. So what happens when the growth becomes broad-based? You will see other funds doing better than that.
Yeah.
So I think it's important to take investors through that process, saying that invest performance is important, but that's the only thing that in the long run, believe me, most of the funds will do well, but the problem is only in the short term and the medium term. You need to make them understand. So if you want to be in a genuinely good multi-cap fund, the allocations have to be at a different level. Yes, if you're a smart fund manager, if you are very confident that today I'm into large cap, at the right time I'll go into mid and small and make sure that investors don't suffer. I mean that's something great, but not all the fund managers can do
they don't do. They stick to their philosophy. They stick to the stocks, and they are in the stocks for a very, very long time. Which is why you will find that HUL, HDFC Bank, HDFC, they are all there in almost all the portfolios. Nobody will have the courage to do that. If they do that, their performance will go down now. So they will lose out on money.
I think that's exactly the reason why you need to go beyond those numbers that you see in the chart.
Exactly.
Because you need to see how the return has come.
Right.
What is the kind of risk the fund manager has taken? And if you rightly said, if you have 2 or 3 funds, either a multi-cap fund or a large cap fund, trust me, except the small and mid-cap where obviously it's very stock specific, you will see different stocks. But most of the funds will have the same stock because universe is so small. And the thing is then what is important is which are the sectors there, how much allocation is to different sectors, how much allocation is for each stock. I think those things become very, very important.
And there is also herd mentality among fund managers. Right. We should not forget that one. I think I have a caller. Ashok Kumar is on the line from Chennai. Good afternoon, Ashok. What's your query?
Hey, good afternoon. Thank you for taking my call. First of all, I have to say thank you. I mean, you're doing a very good job and it's really kind of eye-opener for the small investors like me.
Sure.
So I'm calling from Chennai. I'm 32 years old. I'm currently investing in Mirae Asset Emerging Crude Ship 5000 and Motilal Oswal Most Focused 35 5000 and SBI Banking and Financial 5000, L&T Midcap 5000, L&T Emerging Business Fund 5000 and Reliance Small Cap and SBI Small Cap each 2000 rupees. So these are my portfolio. I started my investment in 2017. I started in the range of 10,000 and I increased it to 15,000 and I am currently in the range of 24 to 25,000. I can even go beyond maybe even 10,000 more. I can invest at present. And my goals are like I wanted to take my retirement little early and I have a target of 2020. I wanted to get my retirement in 2030.
Yeah.
I'm calculating in the range of 1 crore so that I'll be getting some monthly income from the lump sum amount.
Right.
That's my retirement goal. And then apart from that, I have a child. She's currently in first standard, and I have a goal for her as well. For her higher studies, it would be in the range of 2031. I am expecting 40 lakhs, and for her marriage in 2038, it would be in the range of 40 lakhs. And I'm expecting a new kid. I wanted to start up an investment for my new kid as well. So it would be in 2040. I'm expecting 45 lakhs for her higher studies and the marriage. I'm expecting 45 lakhs. It would be in the range of 2047. So I just wanted to understand whether this portfolio is fine and whatever investment I'm doing is this sufficient to achieve my goals.
Right. Ashok, I think you've done some brilliant and very detailed planning in terms of goal setting. I'm sure Hemant and Sachin would love to engage in this conversation and also take this as a role model for planning for somebody who's in that age group. No?
Well, I think, as you rightly said, in terms of strategy, I think he's done the right thing by defining his goal, time horizon, a target, everything is done. And the fact that all his goals are long-term and the fact that he's investing in equity, which is again a wonderful thing to do. My only concern with this portfolio is, one, there are far too many funds. Second is, if you really analyze the portfolio, there's too much money going into small and mid-cap. So I believe that you need to create more balance in your portfolio in terms of risk and reward. Individually, if I were to look at his funds, each fund is among the best fund in that category. When I say best, again, I'm not only looking at performance, I'm also looking at portfolio quality and the potential of doing well from here. So I think there he has done a great job.
Right.
My recommendation would be to kind of reduce his exposure to small and mid cap and maybe look at more as multi-cap funds, which I think will create that balance. And it will be easier for him, even though when you continue in a disciplined manner, it's easier for you and you have a time horizon in mind, it's easier for you to handle volatility. So I think creating more balance in terms of allocation to different segments, I think that will really help him a lot.
Absolutely. Ashok, do you have any follow-up question?
Yeah, so I can invest 10 more thousand, so where I can invest more in the given funds, where I can invest more. And the next question would be, whatever I'm doing the investments, would I be able to achieve my goal?
To start with, what you can do is you have Mirae Emerging Blue Chip Fund, you can add to that. And you also have Motilal Oswal 35, you can add to that. So the additional money you can invest in those two funds. Like I said, you need to create a balance, and one way of doing that is also increase your allocation to those multi-cap funds, because Mirae Emerging is like 50% large cap, 50 mid cap. So you can kind of increase your allocation to that. In terms of goal, two things you need to see clearly: whether the goal that you have set for yourself, whether you have taken inflation into account or not, especially for education, because there inflation has to be 10%. So just rework on that. But broadly, I feel that investment that you're making, you should be able to achieve those targets.
Right. I think we have time to take one more query before I engage with a very interesting discussion with Sachin later in the show. Bharat has tweeted this query. He is investing through SIP 4,000 rupees in Reliance Tax Saver since 2017. Due to the fall in NAV, he says his principal has tanked. He's using the word tanked. He wants to know what to do with this, stay invested or switch. This is a typical problem for tax saving funds, I suppose.
See, it's a tax saving fund, so clearly there is a lock-in period of 3 years. He started investing in 2017, so he's not completed that. So there is no way he can exit from there. But let me say that if I were to look at the funds in this category, Reliance Tax Saver hasn't actually kept pace with the peer group. It has actually been more volatile, it's fallen more. He can't do much about the existing investment. My recommendation is that if he wants to continue investing in ELSS as a category, maybe he can look at Mirae Asset Tax Saver or Axis Long Term, one of those funds basically. This fund has not been doing so well for the last couple of years.
Right. In a market like this, we typically would look for safety, we would look for stability and say that, look, I don't want to digest too much of volatility, I can't take the risk. But there are people who would want to be aggressive, take risk and go forward. Sachin, you have recommended some infrastructure funds to your clients.
Yeah, we have recommended. So, as you rightly mentioned, only for aggressive investors. So what we believe is infrastructure funds as a category has actually not done well in the last 2 years. And there are reasons for it. The NBFC crisis, the government getting into the election mode, government managing their own fiscal balances. So a lot of things have happened in the last 1.5 years. And before, the banks have their own NP issues. So the financial closure of many of the companies has been an issue for them. But now the government coming back to the power, and they have already announced an ambitious plan of 100 lakh crore over the next 5 years. So translating into a 20 lakh crore of an annual run rate. So which is practically 3 times which currently what the government is doing. But I think as per Niti Aayog, they are saying that they are currently doing around 7 to 7.5 lakh crores of annual investing in infrastructure as a segment. So we are talking about 3 times investment in infrastructure. So there are lot of opportunity which are there. Secondly, there are a lot of stocks, lot of funds which are under-owned. Because as you guys rightly mentioned, a lot of fund managers, lot of individual investors have just stuck to the so-called quality stocks which are richly valued. So they are under-owned. Thirdly, we have an interest rate scenario which is likely to be benign for various reasons, we all know. So, and because of this whole NBFC crisis, banking crisis, the benefit of lower interest rate has not percolated to a lot of infrastructure companies so far. But however, hopefully, the government will do something, and this benefit of lower interest rate will percolate to these companies.
Understood. But which are these infrastructure funds that you are confident people can invest and take risk?
So we are recommending 3 funds. One is Sundaram Infra Advantage Fund. Another is Tata Infrastructure Advantage Fund, and another one is a UTI Infrastructure Funds. So these are the 3 funds which we are recommending as of now. we have selected these funds on the basis of stock selection
Right.
and the potential of individual stocks in the portfolio. So we have not looked at the historical returns. So we at ICICI Securities, our mutual fund research is a part of equity research team. So our equity team, goes in detail in terms of identifying individual stocks in the portfolios.
Right.
So we have understood, we have tried to analyze the future potential of these funds.
Right.
So maybe a 6 months SIP or a 1 year SIP in these 3 funds, and just keep on investing in these cheaper segment of the markets,
Right.
as long as they are underperforming. So basically you are accumulating stocks, accumulating funds at on the cheaper segment of the market in a down cycle.
Yeah.
So whenever the market cycle
limit the percentage in the overall.
Yeah, definitely.
So what, 5%?
More, I think 5 to 10% is the maximum which should be allocated, and that too only for aggressive investors.
Okay.
Because infrastructure in generally is anyway slightly more aggressive or more volatile within the sector's funds as well.
Right.
So you need to be careful about it.
Right.
But if an investor is savvy and ready to take risks, maybe this kind of a strategy and SIP kind of a strategy for the next few months in these kind of funds can make.
Quick comment from you on infrastructure funds.
Well, I think very clearly not for a common investor because in infrastructure the problem is that while there is a lot of potential, there's always been potential, they haven't done well for many reasons. I think if you really see, every time there's a talk of a strong government at the center, the expectation is that infrastructure will get priority. Even now the same case. I firmly believe that yes, infrastructure will do well, but one has to be very careful in terms of selection of funds, because there are many infrastructure funds which are not pure infrastructure play. There are funds which still have 20-25% in banking and financial. I mean, which I already have in some other. So I would rather say that if someone wants to look at infrastructure fund, very limited exposure, only experienced investor, and go for pure infra funds, not the fund which have everything in it.
Everything in it. Okay, very interesting conversation today. But I want to conclude on a very interesting aside. The way we look at infrastructure today will be different from the way we look at infrastructure, say 5 or 8 years down the line. Those who can put up infrastructure for electric vehicles and solar power, I'm sure would be winners, and we need to look at them, because you really need charging stations, go along, if this is the way, and this is the way we look at as far as future vehicle industry is concerned. I think that's the new infrastructure we need to look at. A little too early, maybe you should keep an eye on that one. And for now, that's all we have on this special edition of Mutual Fund Guide. Thanks for watching BTVI. More news and updates on the other side of the break.